If you want a no bullshit guide on how to build an investment portfolio that is backed by real economic theories and financial principles, that is straightforward and easy to set up, that is set to outperform the S&P 500 this year and in the next years to follow, and where the video isn't a big ad for some random investment platform that you've never heard of, filled with a bunch of sound effects and video effects bullshit to spike your dopamine and hide the fact that the investment advice that they are giving is terrible, then congratulations, you clicked on the right video. Now, before we start, I'm going to make some assumptions about you. I'm going to assume that you're a student or that you're new to the workforce and that you don't have time. And in that case, if these assumptions are true, then this video is perfect for you because I've dedicated my time to find the best platform, the best stocks, and learn these theories so you can save hours of your time and literally just copy me. Okay, so before we start and before I tell you exactly what shares I'm investing in and how much, we're going to cover the theories and principles behind this portfolio so you guys can understand the basics, and I'm going to explain it in the most simple way possible so that literally a 5-year-old could understand. And through this, you're going to understand exactly when to sell and when to hold. Now, my whole portfolio is based on this economic theory called the adaptive expectations hypothesis. And in simple terms, this just means that if people expect price to increase, price usually will increase. Now, we can expect this price increase to happen in the short term, which is a period that is less than 3 years. This is a simple supply and demand curve. And this A here and this A here just means aggregate supply and aggregate demand. So total supply and total demand. On the bottom axis, we have Y, which is output. And on the vertical axis, we have the dollar sign, which is price. So let's just say this is for the Apple stock. And let's say currently demand perfectly meets supply at point A, which is called the equilibrium. So let's just say that right now the market is demanding 100 shares of Apple and they're demanding it at a price of $1. And let's just say that people are now expecting the price of Apple to increase because Apple is a great company, they're keeping up with technology, they're becoming more efficient, and they're releasing new products. So people are expecting the stock price to increase. So what happens? The aggregate demand shifts to the right as demand for the stock increases. And this demand increase also causes an increase in price from the stock to go from $1 to $2. So now people are seeing that, okay, people are actually making money in the stock market and they turn their $1 into $2. So now I'm going to invest right now while it's still low, while it's at $2, and let's see what happens. So because in the past price went up and demand went up, these people expect that price will continue to go up and demand will continue to rise, and they are usually correct. So they get in at this point here, which is A double prime. And in this point here, the market demand is 300 shares of Apple, and the price has risen all the way up to $3. So now the first person who bought the Apple share for $1 is very happy because now he's made $2 per share. The second person is also pretty happy because he made $1 per share. And the third person is relatively happy because he still thinks that, okay, the price is going to increase because it increased in the past. So I'm going to make money like person 1 and person 2 did as well. But obviously this is basically a fantasy and prices can't keep increasing. And if they were, it would be like a bubble getting bigger and bigger and bigger until one day it just popped and destroyed everything in its path. So this is where the medium to the long run comes in, and this is where price corrections are made. So this happens in a period of 3 to 10 years. So what happens when the price of these shares keeps increasing? Let's just say that as the prices of these shares are increasing, the prices of everything around you is also increasing. So the cost of living is increasing. This causes people to become very unhappy because they are left hungry. They can't afford these increases in prices, these inflationary pressures, because now bread went from all the way from $1, now it's worth $3 per loaf. So now they're left hungry, now they're upset, and now they're demanding higher wages so they can keep up with this cost of living. And these firms that employ them, they say, okay, fair enough, you guys have to survive to work for us, so we are going to grant you higher wages. So these firms put more money into wages, and they put less money into their output. So let's just say in the Apple example, Apple is now paying their employees a lot more, and now their output has dropped because more of the proportion of their income is spent towards wages and less is spent towards output. So this causes the supply of goods to decrease. Ultimately, this leads to a happy consumer because now they're getting paid more. Now they can actually keep up with cost of living. Now they aren't hungry, and now they're happy. So in this same graph here, we can graph this by this shift in the aggregate supply from here to here. So if you remember, our equilibrium in the short run was at this point here, A double prime. And now because firms are paying more to their employees and because output has dropped, our equilibrium slowly creeps up to this point here, which is point B. And this is because, as I said, the supply of goods drops. So because the supply drops, the demand is also dropping and it returns back to its natural level, which was 100. But what happens to the price? The price has increased all the way from $1 to $5. So has there really been a price correction made? Isn't this just free money? And the short answer is no, not really. It's not free money, and the correction has been made because of a principle called the neutrality of money. And this basically says that this increase in price is equal to the nominal increase in money. And the nominal increase in money is the total supply of money. And in simple terms, this just means that there is no free money because $1 back then could buy you one burger. And fast forward to the future, to the present day, $5 can buy you one burger. So price has corrected itself. Even though it is higher, it is still worth the same, and output has dropped back to its natural level. So all these corrections have been made in the medium to long term. So what is our goal? Our goal is to get out before we enter the medium run. Our goal is to get out when we're all the way back at this point here, all the way here, when price is at its highest, when demand is at its highest, and before any corrections have been made. That is our goal, so we can maximize our profits. So how do we know when we are entering the medium run, and how long can we expect the short run to go? Now, as I said before, the medium run is a period between 3 to 10 years. So that is your minimum period. Now, we have already been experiencing pretty bullish movement for 1 to 2 years. So on the minimum side, we have a whole year left. Now, there are some circumstances that I think will change this. For example, the election of Donald Trump. His election period is 4 years. So I think that we will continue this bullish momentum for another roughly 4 years. So now we're up to all the way from 3, which is the minimum. Now our minimum is all the way up to 6 years. Again, this is just a rough estimate, and it will be ignorant to say that this will be the exact year because this is the financial market and things are incredibly random. But this is just a guesstimate and an assumption. So now we're saying a minimum of 6 years, and it could creep up to 10 years depending on what happens after. Maybe there is no war during that time, and that the new president is also bullish on crypto and stocks, and the stock market continues to rise. So is everything impacted by this price correction that we see in the medium term? No. There are some stuff that is basically immune to this, and they are immune because of a financial principle called the law of inertia. And in simple terms, this just means the resistance to change. Index funds, for example, are probably the most immune things that you can find in the financial market because from the day that they were started, which was in this graph, 1985, all the way up to present date, which is 2024, they have done nothing but increase. Sure, there are some periods here of pullbacks like here, or like here during the financial crisis, or like here during COVID, but in the long run, everything has increased exponentially. This is because for the longest period of time, as soon as the S&P 500 was created, it was known for the ability to be a safe investment and to provide money no matter what happens in the market. So it is a very safe investment, and there is so much resistance to change in this because so many people believe this, and they don't want to believe that one day this whole thing could crash, which I don't think is likely, but again, it could happen. Now, because they don't want to believe this, it's likely not going to happen as long as they expect that this will continue to rise. Now, imagine the workers here that are very smart and they pick these top 500 companies meticulously every year. Do you think that they would want to be known as a generation of workers that caused this great decline? Or do you think the investors that were putting money into the S&P 500 would want to lose all this money? Obviously not. They're going to keep telling people to invest, and in return, it's going to keep increasing like this. So there are some things that are immune to this price correction in the medium to long run. This goes on to the third financial principle, which is diversification. And in simple terms, it just means to spread your risk. I'm going to give you two cases or two scenarios here. In this first scenario, let's say your portfolio consists 100% of Apple. You're very bullish on Apple. You think that the company is performing amazingly and it's going to keep performing as it is. So you put $10,000 or 100% of your portfolio into Apple. Now let's say 5 years have passed and now Apple, for some reason, has completely changed from producing phones and technology, and now they've entered this completely random market like the farming market. So 5 years have passed and now they've destroyed their company and the stock price has plummeted. So now your initial $10,000 investment is worth $7,000, and now you are very unhappy because you've just lost $3,000 because you put everything into this one Apple play here. You didn't spread your risk. Now let's go into case two. You still think that Apple is going to increase, so you put 25% of your capital or $2,500 into Apple, but you also think that the travel industry is going to increase, so you put $2,500 there, and you also want to be safe, so you put half of your portfolio into something that is pretty much guaranteed to generate a return over a course of time, so you put 50% into the S&P 500. Now let's say 5 years have passed and still Apple have made this weird change into the farming industry, and your $2,500 investment has dropped by 30% to $1,750. So do you still lose money? No, you don't, because you've also put money into the travel industry, which has continued to increase slowly because they've invested in more technology and they've become more efficient, and your investment into the S&P 500 has also continued to increase. So because you've spread your risk, the loss that you incurred from this Apple investment was offset by the money you made in the travel industry, and you made more on top of that with the S&P 500, and as a return you netted a net profit of $750. So even though Apple did terribly in this 5-year period, you still made money. Now, can you diversify everything? No, you can't. There are some things that you simply can't diversify. This is a chart here that I have where on the bottom axis we have the number of shares and on the vertical axis we have risk. Now, as we can see, the more number of shares that we invest in, or the more we diversify our portfolio, the less risk we have. And this is a graph of diminishing returns. So around like this point here, we reach a period where it's not really worth it to keep on diversifying because we're going to get very small increments of lower risk, but it's not really worth it. That period here would be something like 20 to 40 shares in your portfolio or 20 to 40 different industries. Now, this line here is going to continue to be tangent to this line here. So it's never going to meet this line because you're always going to have a very small amount of risk because the financial market at the end of the day is very unpredictable. But you've essentially eliminated a lot of your unsystematic risk. You went from all this risk here, now you've gone to this point where there's barely any risk in your portfolio. So you've gotten rid of unsystematic risk, or another word for this is firm-specific risk. So in the previous example with Apple travel, and the S&P 500. Let's just say there was no S&P 500 and you just had 50% in Apple and 50% in travel. So the Apple industry is obviously the technology industry. Let's just say something terrible happens to that industry and you lose a bunch of money into that, but your portfolio still remains healthy because you diversified your portfolio and you also put money in travel. So now you've gotten rid of this firm-specific risk, which was specific to the technology industry, by also investing in travel. So you've gotten rid, or you've lowered your total risk. So if we look here, let's just say, for example, at this point here, you have one share. And at this point here, you have two shares. So in this, just by increasing one share, you've almost halved your risk. But the further we move along this, the less risk we get rid of, and that is why it is diminishing return. But you're probably asking yourself, okay, so we can pretty much get rid of unsystematic risk. What about systematic risk? So systematic risk, in simple terms, is just risks that you can't get rid of. So it's risks that impact the entire market. For example, as you can probably remember, the 2008 global financial crisis is the perfect example of this. And this is when the housing market entered this big bubble and essentially collapsed. And this collapse caused stocks to decrease in price, global economies to decrease in price, and banks to decrease in price. Now, no one could have really predicted this, and it wasn't firm specific. So this is why this was called systematic risk. It's risks that you simply can't avoid. So that's why in this graph here, there is still all this portion here that you can't get rid of, because that's just risks that will impact the entire market and you can't diversify. So now that we've gone through everything, now let's go on to the exact platform that I used, how I get rid of fees, and the exact stocks that I'm investing in and how much I'm investing in. So the app's name is called Stake. I use it because it has literally the most simple interface among any other apps. There's no brokerage, you don't need to call anyone up. It's just simple, fast, quick, efficient. At the bottom here, you'll see portfolio, watching, markets, search, and more. You only need to be concerned with portfolio and search. Search is obviously how you search stocks. So if I wanted to buy Apple, I'll just search Apple. I'll press buy. You'll come up with three options here: limit, market, and stop. You want to press market and just type in how much you want to pay. The portfolio button on the bottom shows you your entire portfolio that I will post screenshots of shortly. And at the top here, you can see Oz and Wall Street. This will be your Australian portfolio, which I don't have any money in, and I don't recommend that you put money in either. This is the ASX, the Australian Stock Exchange, which is just less volatile and doesn't perform as well as Wall Street, which is the NYSE, the New York Stock Exchange. I recommend putting money into that. So how do you put money in? You press this big white button that says add, place in how much you want to put in. Now, this is how you cut fees and save a lot of money, because these fees add up. The first one says deposit with. Make sure you pick one that says no fees. As you can see, pay to and bank transfer in my case would have no fees, so I'd pick that. Speed, instead of instant which charges fees, I would just press regular. Now this will take a little bit longer to enter your account, but again, you'll be paying a lot less. And these small amounts of money really add up. Now, if you guys want to support me, I'll have a link below where you can sign up to this app. And if you want as well, don't just take my word for it. Look up the app, look up the word Stake, the application, the platform, the company, do your own research as well. Because a lot of these people are just, as I said in the introduction, it's just one big paid advertisement for this random trading platform. Obviously, this is not a paid advertisement and this is not a random trading platform. This is one of the biggest platforms that you can get. If you go on the App Store, it's up there, and it's up there for a good reason because it's so easy and simple to use. So now that you know how to use the app, these are all the stocks that I have invested in. And literally all you have to do is write down what the phrase like AMD or NVDA, copy that into Stake and into the search function and buy it as I showed you. And yeah, literally just copy me and print money. Make sure you put roughly 50% into the index fund that I was talking about, S&P 500. In my portfolio, it's called SPY. Put roughly 50%. If you are a more risky person, you can put less into the S&P 500 and put more into the stocks. And if you tolerate less risk, if you don't want to be that risky, just put more into the S&P 500 and less into the stocks, because the S&P 500, as I said, it's the law of inertia, but these stocks, they do depend on future expectations. So in the medium term, they will likely go down. So the goal of this is to get your money before it reaches that medium term, and then take money out of all your stocks and recycle them into the index fund, where that will continue to grow until the next bullish cycle that we get, the next bullish big news that we get, the next, for example, like maybe a new prime minister is elected for the US that is very bullish on stocks and is very capitalist type of person, then you would think, okay, now's a good time to invest. So then you would take money back out of the S&P 500, put them back into stocks, and then go back to this like 50% in the S&P, 50% in more risky stocks. And what that does again is diversify your portfolio. I have roughly 30 to 40 different stocks here, and they're all very well diversified. So you don't have to worry about any of that. They cover a wide range of industries, from technology to food to agriculture to travel, a bunch of different stuff. So if one industry does poor, the other will pick it up and make some more. I hope you enjoyed this more raw style of video. I didn't litter this video with sound effects or bullshit video effects that triggers your dopamine, spikes it up, and masks terrible investment advice. This was real raw advice that I've learned from university, that I've learned from practical application, that I hope you guys can enjoy as well. If you have any questions or anything, leave them in the comments below, and just print some money.